I need to be direct with you about something that's happening right now in the financial markets, something that could fundamentally change the retirement landscape for anyone over 50. And if you're not paying attention, you could watch decades of careful saving evaporate faster than you ever thought possible. I'm talking about a perfect storm that's brewing, a convergence of factors that hasn't happened in over 40 years, and the people who understand what's coming are quietly making moves right now, while everyone else is distracted by headlines and political theater. Let me paint you a picture of what's actually happening behind the scenes. Right now, central banks around the world are buying gold at a pace we haven't seen since the early 1970s. The World Gold Council just reported that central banks purchased over 1,000 tons of gold for the third consecutive year. Think about that. These are the institutions that print money, that control monetary policy, that have access to information you and I will never see. And they're converting their reserves into physical gold at record levels. Why would they do that? What do they know that the average person watching CNBC doesn't? Here's what's really going on. The global financial system is undergoing a transformation that most people won't recognize until it's too late. We're watching the slow-motion collapse of the post-World War II monetary order. The Bretton Woods system died in 1971 when Nixon closed the gold window, but what replaced it, this dollar-based reserve system, is now showing cracks that can't be papered over anymore. China and Russia aren't just buying gold for fun. They're building an alternative to the dollar system. The BRICS nations are actively working on trade settlements that bypass the dollar entirely. Saudi Arabia is now accepting yuan for oil sales. These aren't conspiracy theories. These are documented facts that have massive implications for anyone holding dollar-denominated assets. And that includes your 401k. Think about what's in your retirement account right now. If you're like most Americans over 50, you've got a mix of stocks and bonds, maybe some mutual funds, all denominated in dollars, all dependent on the continued strength and stability of the U.S. financial system. But here's the problem. The system isn't stable. It's being held together by unprecedented levels of debt and money printing. The national debt just crossed $36 trillion. That's trillion with a T. The interest payments alone are now exceeding defense spending. We're paying over $1 trillion a year just in interest on our debt. How do you think that ends? There are only 3 ways out of this. You can grow your way out, which requires economic growth that exceeds your debt growth. We're not doing that. You can cut spending dramatically, which is political suicide. Nobody's doing that. Or you can inflate your way out, which means printing more money and devaluing the currency. Guess which option they're going to choose? They've already chosen it. The Federal Reserve's balance sheet exploded from under $1 trillion before 2008 to over $9 trillion at its peak. They printed more money in 2 years during the pandemic than existed in the entire history of the country before that. And while they've tried to reduce it slightly, the trajectory is clear. When the next crisis hits, and it will, they'll print again. They have no choice. This is where gold comes in. And this is why what I'm about to tell you is so critical for anyone over 50. Gold isn't just a shiny metal that people like to wear. It's a monetary asset that has preserved wealth for over 5,000 years. It's the only form of money that isn't simultaneously someone else's liability. When you hold physical gold, you're not dependent on a government's promise, a bank's solvency, or a company's earnings. You're holding real, tangible wealth that has survived every currency collapse, every empire's fall, every financial crisis in human history. And right now, gold is telling us something important. It's been hitting all-time highs while most people aren't even paying attention. It crossed $2,700 an ounce recently. But here's what's fascinating. It's doing this while real interest rates are still positive, while the stock market is near all-time highs, while there's no obvious crisis happening. Gold usually rallies during crises, during times of fear and uncertainty. But it's rallying now, during what appears to be calm. That's not normal. That's a warning sign. The smart money knows something. They're positioning ahead of what's coming. And if you're over 50, you don't have time to wait and see how this plays out. You don't have decades to recover from a major market crash. You need to be thinking about protection right now. Let me tell you about what happened to people who didn't hedge during previous crises. In 2008, the average 401k lost over 30% of its value. People who were planning to retire in 2009 or 2010 had to delay retirement by years. Some never recovered. They worked into their 70s not because they wanted to, but because they had to. And that was just a financial crisis. That was a crisis within the system. What we're facing now is potentially a crisis of the system itself, a loss of confidence in the dollar as the world's reserve currency. That's a completely different magnitude of problem. Think about what happened in the 1970s. That's the last time we had this combination of factors: high inflation, loss of confidence in the dollar, geopolitical instability, massive government debt. Gold went from $35 an ounce in 1971 to over $800 by 1980. That's not a 20% gain or a 50% gain. That's a 2,200% increase in less than a decade. People who had gold in their portfolios during the 1970s didn't just survive, they thrived. While everyone else was watching their purchasing power evaporate, gold holders were preserving and growing their wealth. Now, I'm not saying we're going to see that exact scenario play out again. History doesn't repeat, but it often rhymes. What I am saying is that the conditions are similar enough that anyone over 50 should be paying very close attention. Here's what most financial advisors won't tell you. The traditional 60-40 portfolio, 60% stocks and 40% bonds, doesn't work in an inflationary environment. Bonds get destroyed when inflation rises and interest rates go up. We saw that in 2022 when bonds had their worst year in history, and stocks don't do well in stagflation either. They need economic growth to justify their valuations. So what's the hedge? What's the asset that performs when both stocks and bonds are struggling? Historically, it's been gold, and increasingly silver too. Silver is interesting because it's both a monetary metal and an industrial metal. It's used in solar panels, electric vehicles, electronics, medical applications. The demand for silver is growing while supply is constrained. And unlike gold, which is mostly held by central banks and investors, silver gets consumed in industrial applications. Once it's used, it's gone. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically around 15-1. Right now, it's over 80-1. That means silver is historically cheap relative to gold. If that ratio reverts to its historical mean, silver could outperform gold by a significant margin. But here's the thing. You can't just go out and buy physical gold and silver and stick it in your 401k. The IRS has specific rules about retirement accounts. You can't hold physical precious metals in a standard 401k or IRA. They have to be held by an approved custodian in an approved depository. That's where a gold IRA comes in. It's a self-directed IRA that allows you to hold physical gold, silver, platinum, and palladium. You can roll over funds from your existing 401k or IRA into a gold IRA without triggering taxes or penalties, as long as you do it correctly. Now, if you're sitting on $100,000 or more in retirement accounts, this is something you should seriously look into. I've put together a free guide that explains exactly how gold IRAs work, what the rules are, how to avoid the common mistakes people make. It's in the description below. It covers the whole process, from choosing a custodian to selecting the right metals to understanding the storage requirements. No obligation, just information that could be valuable for your situation. All right, back to why this matters right now. The timing of this is critical. We're at an inflection point in the markets. The Federal Reserve is stuck between a rock and a hard place. If they keep interest rates high to fight inflation, they risk breaking something in the financial system. We've already seen bank failures. We've seen stress in the commercial real estate market. We've seen cracks appearing in the regional banking system. But if they cut rates too much, they risk reigniting inflation. And inflation is the silent killer of retirement savings. It doesn't show up as a loss in your account statement. Your balance might even go up nominally. But your purchasing power, your ability to actually buy things with that money, erodes steadily over time. Let me give you a concrete example. Let's say you have $500,000 in your 401k right now. You're 55 years old, planning to retire at 65. If inflation averages 5% over the next 10 years, which is below where we've been recently, that $500,000 will have the purchasing power of about $307,000 in today's dollars. You'll have lost almost 40% of your real wealth, even if your account balance stays the same. But if you had 20% of that portfolio in gold, and gold appreciates at even a modest rate during that inflationary period, you could offset much of that loss. You're not trying to get rich with gold. You're trying to preserve what you've already built. This is especially important for people over 50, because you're in what financial planners call the red zone. That's the 5 to 10 years before retirement, and the first 5 to 10 years after. This is when sequence of returns risk is highest. If you have a major market downturn right before or right after you retire, it can devastate your retirement plans because you're either about to start drawing on that money or you've just started drawing on it. You don't have time to wait for a recovery. You need that money to live on. And if you're forced to sell stocks at a loss to generate income, you lock in those losses permanently. You can't recover from that. Gold provides a buffer. It tends to move inversely to stocks during crisis periods. When stocks crash, gold often rallies. That means if you need to generate income during a market downturn, you can potentially sell some gold at a profit rather than selling stocks at a loss. This isn't theory. This is what happened in 2008. While the S&P 500 dropped 37%, gold was up 5%. In 2022, when both stocks and bonds were down, gold was essentially flat, providing stability when everything else was falling. Now, let's talk about what's happening in the physical gold market right now, because this is where things get really interesting. There's a growing disconnect between the paper gold market and the physical gold market. Most gold trading happens on the COMEX, the Commodities Exchange in New York. This is where futures contracts are traded. These are paper contracts that represent gold, but most of them never result in actual physical delivery. They're just bets on the price of gold. But increasingly, people are standing for delivery. They're saying, I don't want a paper contract, I want the actual metal. And this is creating stress in the system because there's far more paper gold than there is physical gold to back it up. The LBMA, the London Bullion Market Association, recently reported that their vaults are seeing significant drawdowns. Physical gold is leaving London and going to places like Switzerland, Dubai, and Asia. This is physical metal, moving from west to east, from financial centers to places where people want to hold real assets. China is a perfect example. The Chinese government has been encouraging its citizens to buy gold. They've made it easier to purchase. They've promoted it through state media. They've integrated it into their financial system. And Chinese citizens are responding. Gold demand in China has been at record levels. Why would China do this? Because they understand that in a world where the dollar's dominance is declining, gold becomes increasingly important. They're preparing for a different monetary system. And they're making sure their population has real assets, not just paper promises. This matters for you because as physical demand increases and supply remains constrained, the price has to go up. It's basic economics. And if there's ever a crisis of confidence in the paper gold market, if people start demanding physical delivery en masse and the system can't deliver, you could see a massive spike in the price of physical gold. The people who own physical gold in that scenario will be sitting pretty. The people who own paper gold, gold ETFs, gold mining stocks, they might not fare as well. There's no substitute for holding the actual metal. Now I know what some of you are thinking. Gold doesn't pay dividends. It doesn't generate income. Why would I want an asset that just sits there? That's a fair question. And the answer is that gold is insurance. You don't buy insurance expecting to make money on it. You buy insurance to protect against catastrophic loss. Gold is financial insurance. It protects your portfolio against currency debasement, against systemic financial crisis, against the kind of events that can wipe out traditional investments. And here's the thing about insurance. You have to buy it before you need it. Once the crisis hits, it's too late. The price of protection goes up dramatically, or it becomes unavailable entirely. Think about what happened during the pandemic. People who had gold before March 2020 did great. Gold rallied from around $1,500 to over $2,000 in a matter of months. But if you tried to buy physical gold during the panic, you couldn't find it. Dealers were sold out. Premiums were through the roof. The people who waited until they needed it paid dearly. We're in a similar situation now, except the crisis hasn't hit yet. We're in the calm before the storm. The smart money is positioning now, while gold is available, while premiums are reasonable, while you can still make rational decisions without panic. Let me tell you about the supply situation, because this is something most people don't understand. Gold is actually quite rare. All the gold ever mined in human history would fit in a cube about 70 feet on each side. That's it. That's all the gold that exists above ground. And new gold production is declining. The easy gold has been found. The big deposits have been mined. What's left is lower-grade ore in more difficult locations. It costs more to extract, it takes longer to bring new mines online, and the environmental regulations are getting stricter. Meanwhile, demand is increasing. Central banks are buying. Asian consumers are buying. Investors are buying. The supply-demand dynamics are pointing in one direction, and that's higher prices. Silver is even more interesting from a supply perspective. Silver is often mined as a byproduct of other metals like copper, lead, and zinc. So silver supply is dependent on the economics of those other metals. If copper prices are low, copper mines shut down, and silver supply drops, even if silver prices are high. We're also seeing silver being consumed in applications that didn't exist a decade ago. Solar panels use silver. Each panel contains about 20 grams of silver. As the world transitions to renewable energy, silver demand from solar alone could increase by several 100 million ounces over the next decade. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure uses silver. Medical applications use silver for its antibacterial properties. This industrial demand is structural. It's not going away, and it's growing. So you have declining supply, increasing industrial demand, and on top of that, increasing investment demand as people wake up to the monetary crisis we're facing. That's a recipe for much higher silver prices. Now, here's where this gets personal for anyone over 50. You've spent your entire working life building your retirement savings. You've been responsible. You've contributed to your 401k. You've tried to do the right things. And now you're approaching the finish line. But the finish line is moving. The retirement you planned for, the lifestyle you expected, it's all based on assumptions about the value of the dollar, the stability of the financial system, the returns you'll get from traditional investments. And those assumptions are being challenged right now. You can't afford to be wrong about this. If you're 30 years old and you make a mistake with your investments, you have time to recover. You can work longer, save more, adjust your plans. But if you're 55 or 60 or 65, you don't have that luxury. A major loss at this stage of life can be devastating. That's why hedging is so important. You're not betting against the system. You're not predicting doom and gloom. You're simply acknowledging that there are risks, significant risks, and you're taking prudent steps to protect yourself against those risks. Think of it like wearing a seatbelt. You don't wear a seatbelt because you expect to crash. You wear it because if you do crash, it could save your life. Gold in your portfolio is the same thing. You're not expecting the financial system to crash. But if it does, gold could save your retirement. The question isn't whether you can afford to allocate some of your portfolio to gold. The question is whether you can afford not to. What's the cost of being wrong? If you don't own gold and everything turns out fine, you missed out on some potential gains. But if you don't own gold and things go badly, you could lose everything you've worked for. That's an asymmetric risk. The downside of not having gold is far greater than the downside of having it. Let me walk you through what a reasonable allocation might look like. Financial experts generally recommend anywhere from 5% to 20% of your portfolio in precious metals, depending on your risk tolerance and your outlook on the economy. If you're conservative, maybe you start with 5% to 10%. If you're more concerned about the risks we've been discussing, maybe you go higher. The key is to do it strategically. You don't want to panic and dump your entire 401k into gold. That's not diversification, that's speculation. But you also don't want to ignore the warning signs and do nothing. A balanced approach might be to take 10% to 15% of your retirement savings and move it into a gold IRA. You keep the rest in your traditional investments, but you've created a hedge. You've built in some protection. And you can sleep better at night knowing that if things go sideways, you've got a safety net. The process of setting up a gold IRA isn't complicated, but there are rules you need to follow. You have to use an approved custodian. The gold has to meet certain purity standards. It has to be stored in an approved depository. You can't take personal possession of it while it's in the IRA, or you'll trigger taxes and penalties. But once it's set up, it's actually quite simple. The custodian handles the storage and security. You get regular statements showing your holdings. And when you eventually take distributions in retirement, you can either take physical delivery of the metal or sell it and take cash, whichever makes more sense for your situation. The important thing is to work with a reputable company. There are a lot of gold dealers out there, and not all of them are created equal. You want a company that's been around for a while, that has good reviews, that's transparent about their fees, and that has experience with retirement accounts specifically. That's why I put together that guide I mentioned earlier. It includes a list of questions you should ask any gold IRA company before you work with them. Things like, what are the fees? How is the gold stored? What happens if the company goes out of business? How do you take distributions? These are important questions, and you deserve clear answers. Now let's talk about timing, because I know some of you are thinking, gold is already at all-time highs. Isn't it too late? Shouldn't I wait for a pullback? Here's the thing about all-time highs. Gold has made all-time highs many times throughout history. In 1980, it hit what was then an all-time high of $800. People said it was too expensive, but adjusted for inflation, that's over $3,000 in today's dollars. So gold today, even at $2,700, is still below its inflation-adjusted high from 1980. In 2011, gold hit $1,900, another all-time high. People said it was too expensive, but it went on to eventually break through $2,000, then $2,500, and now we're above $2,700. The people who waited for a pullback in 2011 are still waiting. They missed out on significant gains. The point is, trying to time the market is a fool's errand. Nobody knows when the perfect entry point is. What we do know is that the long-term trend for gold is up, driven by the fundamental factors we've been discussing. Currency debasement, debt accumulation, geopolitical instability, central bank buying. These aren't going away, so rather than trying to time the perfect entry, a better approach is to dollar-cost average. Take the amount you want to allocate to gold and spread it out over several months. Buy some now, buy some next month, buy some the month after. That way, you average out the price and you don't have to worry about whether you bought at the top. The worst thing you can do is nothing. Paralysis by analysis, waiting for the perfect moment that never comes. Meanwhile, the risks keep building, the debt keeps growing, the money printing continues, and your unhedged portfolio remains vulnerable. I want to share one more story with you because I think it illustrates the point perfectly. I know a guy who was a successful business owner. He sold his company in 2006 for several $1 million. He was 58 years old, planning to retire. He put all the proceeds into a diversified portfolio of stocks and bonds, just like his financial advisor recommended. Then 2008 happened. His portfolio got cut in half. He went from being set for life to wondering if he'd have to go back to work. It took him years to recover, and by the time he did, he was in his late 60s. He'd lost a decade of retirement. He told me later that the worst part wasn't the financial loss. It was the stress, the anxiety, the feeling of helplessness as he watched his life savings evaporate. He said if he'd known then what he knows now, he would have put at least 20% of that money into gold. It wouldn't have prevented the loss entirely, but it would have cushioned the blow. It would have given him options. Don't be that guy. Don't wait until after the crisis to realize you should have protected yourself. The time to act is now, while you still can, while you can make rational decisions without panic. Look, I'm not here to scare you. I'm here to inform you. The facts are the facts. The debt is real. The money printing is real. The geopolitical shifts are real. The central bank buying is real. These aren't conspiracy theories or doom and gloom predictions. These are observable, documented trends that have profound implications for your financial future. And if you're over 50, you need to take this seriously. You've worked too hard, saved too much, sacrificed too much to let it all slip away because you didn't take basic precautions. Gold isn't a magic solution. It's not going to make you rich overnight, but it is a proven store of value that has protected wealth through every crisis in human history. And in the environment we're heading into, that protection could be the difference between a comfortable retirement and a financial disaster. So here's what I want you to do. First, educate yourself. Download that free guide on gold IRAs. Read it. Understand how it works. Second, talk to a qualified professional. Not your typical financial advisor who gets paid to keep you in stocks and bonds, but someone who understands precious metals and retirement accounts. Third, make a decision. Don't procrastinate. Don't wait for the perfect moment. Take action while you still have time. Your future self will thank you. Because when the next crisis hits, and it will hit, you'll be one of the people who prepared. You'll be one of the people who saw it coming and took steps to protect yourself. And while everyone else is panicking, you'll have the peace of mind that comes from knowing you've got a hedge in place. This is your wake-up call. This is your chance to do something about it before it's too late. Don't waste it.